Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD. A great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, we're going to go over the overall portfolio value. Of course, how it's performing by the metrics, our buying power, what I bought, as well as the stocks and how they are performing, and what is on our watch list. So jumping right in for today, we are down $44, down about 0.1%, 0.09%, sorry. Then for the week, we are up $635 with a 1.24% return this past week. That 1 month mark, we are down $109, down 0.21%. That 3 month mark, we're up almost $1,300 with a 2.5% return for the past 3 months. Then we are up $1,916, a 3.84% return year to date. Then we are up $2,450, a near 5% return for the past year. And then all time, we are up $16,419.51, a 46% return all time. And guys, keep in mind, I am a long-term investor. So as you guys can see, it says I started off with $35,000, but I did not. I started off with zero. But as you guys can see, I've had peaks and valleys. It's been as low as 33, as high as like 53, 54, almost $55,000. And then it dropped again down to like 43, and then now it's back up to 51. So there's a bit of volatility when you're holding individual stocks. But guys, remember, the peaks are times to be patient. The valleys are times to be aggressive and purchase stocks at quality, stocks at great prices. So the peaks and valleys are invitations to buy more. So right now my buying power is sitting at 28.76, and our stocks, let's jump right in, starting with Realty Income, sitting at 55.38. We have 170 shares, $9,400 worth of market value. Average cost is right around $65 per share. 18% of the portfolio is in Realty Income. Today we're up nearly $18 with a 0.2% return. Total, we're down $1,600 with a negative 14.87% return. But we do have a dividend coming in on May 15th of $43.69. And that is a monthly dividend. So I love Realty Income, guys. It is a good buy right now, but that is not what I decided to purchase with my free cash. Now, it is a good deal. I would add, of course, at these prices because I'm down $10 per share. But I thought that there was a better opportunity in the market, and that's really important. Opportunity cost is one of the most important things to consider when you're investing, because a dollar put into something versus something else really does affect your return. So a dollar in Realty Income won't grow as much as a dollar in what I've put the money into. Does that mean Realty Income's a bad company? No, it just means that at the current price, I think something else is a better value. So I do love Realty Income. It's given me about $40 a month in dividends for like a year. So I have no issues with Realty Income I would add at these prices, but I just wanted to add something else to the portfolio. And that being, I added a share of Google. So Alphabet, ticker symbol GOOG, is sitting at 169.04. We've got 2 shares now, so I did add 1 share, and the cost average did go up a little bit, but I'm okay with that. Market value is $338 right now. Average cost is $161.14, 0.65, so nearly 1%, about half a percent. I'm trying to get to at least 1% here with Google. So it's only less than a little bit of 1% of the portfolio. Today we're up 13 cents. Total we're up $15 with a near 5% return. So guys, Google is going to be one of the top 5 foundational stocks in my portfolio. And in order for it to be in that top 5 position, I need to add to it. So that's what I'm going to be doing. I'm going to be aggressively putting money into Alphabet when I can afford it. And most importantly, when it's at what I feel is a good price. So as of right now, the 52-week high is 176. The 52-week low is 104. So I bought it near the top, which is fine. I only have 2 shares. So guys, this is one of those things that I see a lot of people get hung up on, is your overall return when you buy at the top, of course, is going to be lower. But given that I have a lot of downside potential with the stock, it's near the 52-week high, so it's more likely to go down than up. I'm excited because I can double up on this, right? With dividends, I get $300 worth of dividends from Altria, right? So I could buy nearly 2 shares of Altria, or excuse me, with Altria's dividend, I could buy nearly 2 shares of Alphabet and double my stake and lower my cost basis. So as long as it's not like a huge position, right? Like I like to keep new positions kind of small so I can double up at lower costs. So it makes sense that I would be hesitant to buy, say, Apple at a huge premium because I'm up like 40% on it. But Google's a little different. 10 to 12 bucks, I'm not as worried about it, especially when it's near the high and I can double or triple up on it when the stock goes lower. So I love Alphabet. As of right now, I want the portfolio positions to be Apple, Visa, CocaCola, then Google, and then I want it to be Berkshire, and then Facebook. So I do need to start allocating more capital towards Apple and Visa, and I will do that when it makes sense to do it. But it will take time, guys. I've been investing for over like 5 years. So, the big positions being like Altria and AbbVie and Realty Income, that's going to take a while to really, get that amount of capital in, which is my day job and dividends. So it will take some time, but I'm willing to wait it out and really be aggressive when it counts. Next, we've got Coca-Cola. So I have 15 shares. It's sitting at $62.10, $930 worth of market value. Average cost is $60.54, so up a little bit here. 1.8% of the portfolio is in Coca-Cola. Today we're down 120, but total we're up $20 with a 2.5% return here on Coca-Cola. So guys, I'm not up big here, a small gain. So I would consider buying here, but I bought Google and Visa instead. Then we've got Altria at 320 shares, sitting at $43.57, around $14K of market value. Average cost is $47.27. 27% of the portfolio is in Altria, down $4.80 today. Total, we're down nearly $1,200 with a small 7.8% loss here. So not a huge loss. And guys, one of the questions I get a lot is, does it freak me out that I have positions like Altria, like AbbVie, and like T. Rowe and Realty Income? No, because I do believe in the companies long term. It's just I would rather have higher growth given my age and time horizon when it comes to investing. So what I want to do is use these bigger positions, like I listed, Altria. Realty Income helps a lot with the monthly dividend, but T. Rowe Price and AbbVie as well, to buy companies that I think are higher growth, that I think are going to grow the dividend a little bit more aggressively, being Apple, Visa, and I think Google and Facebook could be really good dividend growth plays as well. So I do like Altria. I understand that the business is declining. It's a sin stock. People hate it, which is why I wanted to get into it in the first place, because I felt like there was always going to be a good buying opportunity based upon my average cost. Now, sometimes it's been as high as like $52 a share, right? This year it's been as high as like 46. So when I originally bought it at like in the 50s, and I kept cost down averaging. That's why my cost is at 47. But I'm using the cash flow from Altria to buy high quality companies, which is exactly what I want. So I don't want to put more capital into Altria because it's such a big position. I want to use the interest from my capital, the dividends, to buy higher quality. So I could buy something like Google or Apple with just dividends. And that's the long-term trajectory of the portfolio, guys. I'm using my current big positions to put more cash flow into the smaller ones that I want to build up. And I think over time, that will help me get higher returns. Then, of course, we've got my favorite stock in the portfolio, Apple, with one share at $180.94 for market value. Average cost is right around $133 per share. 0.35% of the portfolio is in Apple. Wish that said 35%. But today we're down $244. In total, we're up nearly $50 with a 36% return. Guys, I want Apple to be the biggest position in the portfolio, but not at these prices. I'm not putting more money in because I feel like I'm paying a premium. Now, is Apple worth a premium? Yes. But this much, a near 40% premium? No, I don't think it's worth that. So I want to get it around that 140 to maybe 150 mark. So I want it to drop like 35 to 40 bucks before I even consider, almost $50 here, before I consider putting money in. But I am hoarding cash on the side. I have about $2,500 right now in free cash that I would happily deploy into Apple if it reached those levels. Then we've got AbbVie. 95 shares, 15K worth of market value. Average cost is 95.19. Around 30% of the portfolio is in AbbVie. Today we're down 144. Total we're up 6,300 with a 70% return. And the same day that Altria pays, actually, on the 14th of May, we get paid $147.25. So with that $43, we will be nearly around $200 in free cash within the portfolio that I can use to reinvest. But guys, just like I said with Apple, it's too high at these levels. I don't want to pay a 70% premium. I love those gains. I will water the flowers as long as I can, but I'm not going to water it by reinvesting at these levels because my overall return will go down, and I don't want to buy at these prices. So what I'm going to do with AbbVie, I'm going to let it run. I'm going to use the dividends to buy something like a Google every month that it pays. And then the dividend, I think, will grow over time. Originally, when I bought the stock, it was paying $1.07. It's $1.55 now. So I have faith that the management team will keep boosting up that dividend, so I won't have to keep buying shares. But if it ever does drop down to that like near $100 level, I will be purchasing AbbVie. I just don't want to buy it at a 70% premium. Then we've got Visa. So guys, I added Visa with my free cash from Altria. So right now it's sitting at $271.79. I finally added a share. So I love Visa. It's honestly, I would be happy with it being the biggest position as well. This and Apple can be interchangeable, and I feel like I like Visa's business. I think it's the highest quality business in my portfolio. I view it as kind of the CocaCola of credit cards, of swiping, of digital transactions. So I love Visa. I do want it to be it will be a cash cow. It's a cash cow business, but I think it will be rewarding shareholders for decades. I can see it growing at a huge clip. The margins are insane. So I love the business, right? I use it every day. So right now I only have one share. So of course my market value is going to reflect the stock price, $271.74. Right now the average cost is $268.29. About 0.5% of the portfolio is in Visa. So I love the stock. I am very bullish on it. I want it to be one of the biggest, if not the biggest, in the top two positions. So I will always kind of keep it in that higher tier. And I do think it's a buy here at these levels, guys. It's only a $3 bump up, not huge, a 1.5% difference in the cost I paid. So I would buy Visa here. And I want to keep buying more Visa. I feel like, honestly, Apple and Visa are two of the big stocks that I missed because I have had Apple products. I use AirPods when I mow. I've had an iPhone before. I have a Macintosh. I have done extensive history. Like, I've gone through the history of Apple with Steve Wozniak and Steve Jobs. I've watched the movie a bunch. I love the movie with Ashton Kutcher. I've read the Steve Jobs autobiography by Walter Isaacson. Walter Isaac, sorry. And it's one of my favorite books. I want to read it again, but I got a bunch of books from the Berkshire meeting that I want to get read as well. So Apple is one of my favorite stocks, and I feel like Visa's in that same vein. They're a leader in their field. Great margins, great customer loyalty. They protect their customers, and they have huge margins. So I like Visa, and I want it to be one of the biggest positions in the portfolio. And I think overall the returns will climb as the profitability of the business grows. Then we've got T. Rowe Price sitting at $112.25, 100 shares. I love that share count, by the way. A little bit over $11,000 worth of market value. Average cost is around $110 per share. 21% of the portfolio is in T. Rowe Price. Sorry, the app keeps doing that. It keeps switching back to AbbVie, and I'm not sure why on the top there. But $76 gain today, $250 gain. Total, a 2.31% return on T. Rowe Price. So guys, I love T. Rowe. It's one of those that I think could double over the next 3 to 5 years. The dividend has a great growth track record. It hasn't been as great in the past 3 to 5 years because of COVID. A lot of people pulled their money out as well due to the higher interest rates being 5% on treasury bonds. Even Buffett at the meeting talked about how he sold a percentage of his Apple stake to put it into treasury bonds. So it's a pretty common thing when interest rates go up that stocks go down, because people can get a risk-free return that can usually outpace stocks. So the reason I don't want to like pull out all my money and get a 5% guaranteed return is I think over time, I think the businesses I have can grow at a better clip than 5%. I think owning quality over the course of 3 to 5 years, because we don't know when rates are going to go up, right? Like, we're kind of a victim to rates. But overall, when rates go up, stocks are pushed down, and then when rates go down, stocks get pushed up, because people, as the rate changes, people will either go in and out of U.S. Treasuries based upon that yield. So I'm not surprised to see asset managers like BlackRock went down when that was announced. Charles Schwab, like Vanguard. I'm sure a lot of people pulled out of ETFs and out of those businesses because of that risk-free rate going up. So I'm excited to own T. Rowe. I hope that it keeps going down. I would buy it at these prices simply because it's near my average cost and the dividend's grown really well. The business has great margins. They know exactly how to allocate capital within the business, and management is very aware of the shifts in business. So when they weren't making as much profit, they did a smaller dividend increase. When profits are higher, they do a higher dividend increase, but they never make it so the business struggles to pay it. That's what I love, is they have a very good balance between rewarding shareholders through buybacks and rewarding shareholders through dividend increases. So they are very good. I'd say they're kind of like Apple, but they're way more focused on dividends than Apple is. But I love the business because they are very strategic at how they reinvest their capital to the greatest benefit of shareholders. And that's what a company is supposed to do. And then, guys, of course, we're going to look at our watch list. So Berkshire at 403. I went to the Berkshire Annual Hathaway meeting this weekend. Guys, I had such a blast. I went with my mom, my stepdad, my girlfriend. There's some local shops. We got some See's candy. We went to this restaurant called Spaghetti Works. It's like a small spaghetti shop that has a salad bar. Super cheap, super good. I just love the overall vibe of the Berkshire meeting, guys. It honestly, I feel like it's Disneyland for me. It's like the happiest place on earth. It's one of the only places that I've ever been that it's not weird to invest. Everybody owns Berkshire there, which I don't yet. I went because my stepdad owns a share of Berkshire B, but I want to own it in the future, obviously, because it's on the watch list. But I just love how open and friendly, and just everybody was happy there. Everybody's you just get to celebrate Warren Buffett, Berkshire. Charlie Munger had a great memorial in the video package. They make it fun to invest. It's a celebration of investing. It's a celebration of Berkshire, of the history, of the businesses, of the managers. It's just such a great event that I plan on going to for the rest of my life. This was the third Berkshire meeting that I've been to. The first one without Charlie, so it was a little bit somber. But I think they did a very good job of memorializing Charlie and of, pushing Berkshire towards the future. One of my favorite quote of the entire weekend, though, was in the movie. Buffett talked about Munger and said, "I was the main steward of capital, but anytime I had an acquisition in mind, or a business change, or a management change, anything that was drastic that would affect Berkshire, I asked Charlie." He's like, "I was the steward of capital. Charlie was the architect. Berkshire has been built by the greatest architect and one of the greatest minds to ever live, which is Charlie Munger." He's like, "We have used Charlie's wisdom, his wit, his humor, and we've built something beautiful with it. Berkshire would not be what it is without Charlie Munger." He's like, "So today we memorialize Charlie, and as we do, we memorialize the architect, the blueprint, and and one of the greatest minds to ever live, Charlie Munger," which I thought was just so beautiful. Such a great way to memorialize your best friend. And even during the meeting, guys, he did say, pass it off to Charlie. And then he laughed and said, "I've done that a couple times today, but I caught myself," because Greg Abel was sitting in the spot that Charlie usually sits in. that Charlie used to sit in. So it's going to be a little bit of a change, but I'm excited to keep going to the meetings. And insurance did amazing. They had a crazy big gain in insurance, which they said not to worry about and not to expect because it's the first quarter, and the third quarter is usually when natural disasters and stuff happen. So even though they brought in like $2.5 billion or something like that in insurance, not to expect it through the rest of the year, which makes sense. But I do want to own Berkshire because I want to own See's Candy and Geico. And I love going to the meetings, so if I love it that much, I need to own it. But then, of course, we got Meta at $461.18. Guys, I want to buy Meta at around, I'd say 350 to 400. I know I said 250 to 300. It kind of just depends on where the stock is at. But I want to own it just like I want to own Google, but I want to own it. I want it to be a smaller position than Google. So I want to buy it at around, I'd say 300 to 400 bucks is where I would. Like 350 is probably my sweet spot. So with all that being said, guys, I want to say thank you so much. I apologize for not posting on Thursday or Friday. Thursday night we were over at my mom's place getting ready for the meeting, and Friday we drove out. So I had time, but I was actually reading a book. So I was reading a Berkshire book. So I will be doing 5 videos this week. I'm excited about it. I'm actually off work tomorrow, so I'll probably be doing a couple videos tomorrow as well. So I just wanted to say thank you guys so much for watching. Remember to hit the like button. It does help the video. It helps the channel. It helps me stay motivated as well. Thank you so much for subscribing. I know I didn't post on, I think it was like Thursday or Friday I didn't post, and we still got subscribers. I'm at like 705. So I'm excited to see those numbers keep rising, guys. I'm excited to see the new subscribers. Welcome if you're new. And let me know what you guys are buying down in the comments below. You know, I bought Google and I bought Visa, and I want to keep that going. So thank you guys so much for watching, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.